Welcome to Retiring Today. In today's episode, we're playing a game of fact or fiction retirement taxes. We're going to make a statement about retirement taxes, then separate fact from fiction, and most importantly, talk about how it impacts your retirement. Today, we'll cover, will your taxes really be lower in retirement? Is Social Security truly tax-free? Are Roth IRAs withdrawals always tax-free? Do RMDs only apply to traditional IRAs? And if you move to a no-income tax state, do you really avoid taxes? Here to help us separate fact or fiction, Haley Gutchenreiter and Lauren Merkel. They're both certified financial planners. Lauren is also a certified financial fiduciary and a retirement income certified professional. So today we want to help people separate fact from fiction. Are you guys ready?
We're ready to go.
You're ready.
We got the fact and fiction.
They got fact
Both
and
ready to
fiction,
go.
and I'm going to make some statements, and then we're going to break it down for people. All right. Okay, here we go. Fact or fiction number one, my taxes will be lower in retirement. Many retirees assume they'll pay less in taxes because they're no longer earning a paycheck. But is that true? Is it fact or is it fiction?
I'm going fiction.
I agree with you. Fiction. Fiction it is. And you can understand why people think their taxes will be lower, Lauren, because they're no longer obviously earning a paycheck.
And that's what we've always heard is wait to do any tax planning until you're in retirement because your W-2 wages go away. And most people prior to retirement, they're earning more money than what you've ever earned before. So of course, naturally, you're going to think when the paychecks go away, you're going to be in a lower tax bracket. And for some people, that is true. For some people, you retire, you're going to be in a lower tax bracket, and you might be in a lower tax bracket throughout the entire course of your retirement. But I would say for most people, that's not always the case. For many people, you are in a higher tax bracket right away, or the same, right away when you retire. And for some, it'll dip down, but then it'll come back up and then stay higher permanently.
Haley, why can people sometimes be paying just as much, if not more, in taxes in retirement?
It's because people still need income. And so it really depends on where you drive that income from. If you have multiple different accounts and you saved and saved and saved in a tax deferred account, and that's where you're taking your income, but you don't want your lifestyle to change, you often need the same amount of income coming out of that tax deferred account, and that income is taxed just like how your earnings were. So we do see that people who don't want their lifestyle to change usually be in the same tax bracket, or if you have other income sources like Social Security, a pension, maybe you're 73 or 75 and taking RMDs, that also tax onto your taxable income.
Also, one thing that people misread is in the working years, you have actually more levers to control what your current tax rate is going to be. For many of you, you have an employer-sponsored plan that you can contribute up to $30,000 on a pre-tax basis. So that's $30,000 of income that you don't pay taxes on at all, as well as some other tax strategies when you're working. But when you're retired, if you haven't engaged in any tax planning, now, as you mentioned, you're taking money out, it's taxed the same way, and you need the same amount of income or similar as when you were working. It can be a tax environment that you didn't anticipate.
Okay, he said if you haven't engaged in any tax planning, and that's because maybe you don't want your taxes to be higher. Well, no one wants their taxes to be higher, P.S. But there are some things you can do, maybe starting at like age 57 and leading up to retirement, that could possibly lower your tax bill in retirement.
Yeah, if you built tax diversification within your portfolio, that's ultimately going to be your biggest advantage to control your income in retirement. And what I mean by tax diversification is having different taxable buckets. There's a taxable bucket where you only pay taxes on the capital gains. There's a tax-free bucket where any of the money that comes out of that, you don't pay any taxes at all. It doesn't impact your tax bill. Then there's that tax deferred bucket where you've never paid taxes on it, and when it comes out, it's taxed at ordinary income rates. If you use that like a tool belt where you mix distributions coming out of several of those buckets, you can control or mitigate your tax bill.
Okay, so people watching at home probably want to do that. Lauren, what's a step that they could take to start working towards that now so they have a little bit more control when they retire?
Yeah, one step you can take is do what we call a tax inventory, which look at the different investable resources that you have. And then when you take the money out of it, how is that going to be taxed? That's the inventory that you need to take control over. If all of the investable resources you have are going to be taxed the same way, this is where we need to start implementing tax diversification and conducting strategies like maybe Roth conversions. Maybe implement a Roth conversion strategy where you're taking some money from the pre-tax, you're switching it over to the Roth. Once it's in the Roth, it grows tax-free forever, and you're taxed in that year on those distributions. But if it's at the same level or even lower than what it could be when you retire, this is a good way you can start to create the tax diversification. And you can also look at that non-qualified bucket, which is tax favored, one of the 3 buckets you mentioned. And then you really have some control and ability once you retire to pull income from each one of those buckets independently or together to really control your tax rate.
And if you don't know where you stand from a tax standpoint, maybe you don't understand exactly how some of your retirement savings will be taxed, that's okay. A Retire Ready call is a great opportunity to talk directly with a retirement planner about some of your accounts and maybe the tax implications that those accounts have. So that's a specific question you can ask in one of those calls, or you can ask more broad questions about what's on your mind when it comes to retirement. Okay, it's time for fact or fiction number 2. Ready?
Ready.
Ready. Social Security benefits may be tax-free.
This is a tricky one.
Fact.
And it depends on income.
It does. So that's why it's tricky, because it doesn't take a lot of income for the maximum amount of your Social Security benefits to be taxed. So your Social Security can be taxed up to 85%, and that's going to be dependent on your income, but also dependent on your tax filing status. So if you're married filing jointly and your income is over $44,000, then up to 85% of your Social Security benefits is going to be taxed. If you're a single filer, that threshold is $34,000.
And we should add a little word before income, because it's provisional income. Of course, the calculations couldn't just be your ordinary income or your modified gross, just at a gross income. It's provisional income. What's that all about?
And provisional income actually works in your favor, because what they do is they take 50% of what your Social Security income is going to be, and that is added to your other taxable income sources, and then add some tax-free interest like municipal bonds if you have that. So they're not using 100% of your Social Security income in the provisional income equation, which is really nice. However, as Haley alluded to, that income threshold is not very high, 34 and 44, based on your marital status. So many people do end up paying taxes on their Social Security income, and this is just one additional way that you can save money if you incorporate the planning.
And remind me, it was up until what, 1985, you didn't pay federal taxes on Social Security?
It's 1983 that they set that income threshold, and it's never had a COLA adjustment. So that income threshold's never been adjusted for inflation. So back in 1983, it wasn't very common to have $44,000 as a household income, but today $44,000 doesn't go as far, and people want to spend more. So often we do see that up to 85% of their benefits are taxable.
Yeah, so generally people are going to pay federal taxes on their Social Security is the takeaway. Yeah. But planning for it, again, you talk about that long-term tax plan. If you know that that's coming, it's something you can plan for when you're building out retirement plans.
Yeah, you can plan for it, and you might still, even if you plan for it, you might still pay taxes on your Social Security, but can you pay less? And for sure, you will eliminate that surprise, because even though this has been in legislation since 1983, many people do feel like Social Security income is not taxable. So if it is going to be taxable for you, at least you know, and you can incorporate that into your spending budget in every other element of your plan.
And I would also say that this is often the culprit of under withholding, because when you do go to file Social Security, they do not automatically withhold taxes, even though for most retirees it is taxable. So make sure that you're filling out that voluntary withholding form if you don't want to be hit with a tax surprise at the end of the year.
And here's our third statement. Qualified Roth IRA distributions are tax-free. Roth IRAs, they're known for being tax-free, but are qualified distributions always tax-free?
That is
a fact. They are tax-free, Molly, but you have to play by the rules.
Rules? There are a lot of rules when it comes to this tax stuff.
Yep, so emphasis on qualified. What that means is a qualified distribution happens if you're over the age of 59 and a half, and if that Roth IRA has been open for 5 years. If those two things are true, then when you take withdrawals out of your Roth IRA, it will indeed be tax-free. However, if you're over 59 and a half and you haven't met the 5-year rule, then that means that you're going to be taxed on the earnings, and well, that defeats the point of the Roth IRA.
But one of the cool aspects of the Roth IRA is you're just taxed on the earnings.
Yeah.
Any contributions you put into the Roth IRA, you can always take out as a qualified distribution, which means you're not taxed or penalized on your contributions to the Roth.
Okay, so let's go back to qualified. There is a penalty if you haven't had the account for 5 years. There's a penalty if you take the money out?
There's not a penalty, but you are taxed on the earnings. However, if you're under 59 and a half, then there's a 10% penalty. assessed on the earnings.
Okay, so you have to watch the age and how long you've had the account open. Those are the important,
It's all the rules.
important factors. Okay, so I will say, someone watching, their ears perked up when they heard tax-free in retirement, because that is an important phrase for retirement, because it impacts what you pay in Social Security, and it can impact what you pay for Medicare premiums. So tax-free money in retirement is powerful money, Lauren.
Yeah, because the only thing better than income in retirement is tax-free income in retirement, and that's exactly what you can get with qualified distributions from a Roth IRA. However, you're probably sitting there, yeah, the Roth IRA sounds really nice, but I haven't been able to invest in the Roth IRA for all that long because it only started in 1998. So most retirees, most pre-retirees, the majority of their savings has never been taxed, which means when they take it out in retirement, they're going to pay taxes on it. So now the strategy is, how do you get this pre-tax money you've never paid taxes on before into the Roth, the least costly way to you, so you can sometime in retirement take advantage of these qualified Roth distributions.
Okay, the strategy that I think he's referring to is a Roth conversion. Haley, tell everybody what it is.
So a Roth conversion is when you shift some of that pre-tax money over to the Roth IRA, and in that year, you are taxed on that transaction. But the benefit is that once the money's underneath that Roth umbrella, it can grow tax-free. And so if we ever go through future tax hikes, you're insulated from those future tax hikes. So that's one way that you can take control of your tax bracket in retirement.
And this is something that you need to pay attention to each and every year, because these Roth conversions, unlike some of the other conventional tax planning strategies, you have to do them in the calendar year. You don't have until you file taxes for the following year to take advantage of it for this year. And that's why we say every 12/31, every December 31st, that goes by and you do not have an intentional tax plan in place, you could be potentially wasting opportunity from a tax planning standpoint, which is why even if you're 57 years old, you're still 6 years away from retiring, you need to look at it now, because the more time you have on your side to incorporate these tax planning strategies, the better opportunities you're going to present for yourself down the road in retirement.
I actually just had a family that I met with this morning, and we've been working with them for about 10 years. This year is the last year we're going to be doing a Roth conversion for them, because they, by then, have shifted all of their pre-tax money underneath that Roth umbrella, and they have so much control over the tax bracket now. So it's super exciting when you do create that tax diversification, because if they never use it, it's going to go on to their heirs and transfer tax-free to their legacy.
Yeah, that's a powerful investment strategy, but that wasn't an investment strategy that happened overnight. Like you said, you've been working with them for 10 years, so you don't necessarily want to wait till the year before you retire to start thinking about this.
No, the sooner the better. So the more intentional that you can incorporate that tax plan, the better, or the likely outcome that you're going to save in that retirement tax bill.
Fact or fiction number 4, RMDs only apply to traditional IRAs. Fact or fiction?
This is
Fiction.
fiction.
All right, why is that, Lauren?
Well, RMDs do apply to traditional IRAs. However, there are also other accounts where RMDs can be applicable. One that comes top of mind are inherited accounts. So if you inherit an IRA from somebody, then there's a required minimum distribution from that account. And over the time frame of either your lifetime or a 10-year time frame is dependent upon who you inherited that account from. So if you inherit an account, you need to pay attention to all of the rules around that inherited IRA. And this is also something to be concerned about or think about as you're looking to pass your investments or assets onto your kids as well. What rules of the game are they going to have to abide by? Because those RMDs, when they come out, are subject to ordinary income tax. So any of those required distributions will go on top of the other taxable income that you have, which could have other implications as well.
And although we don't really see this as much, if you still hold money in an employer plan that's pre-tax, so for example, a pre-tax 401k, a 457, a 403b, you also have RMDs that are mandated on those accounts, and those are completely separate from the traditional IRA. So you have to make sure that you're taking out those mandates as well.
Okay, let's talk about the accounts that RMDs apply to make sure everybody's crystal clear on this. It's traditional IRAs, it's traditional 401ks, that's 403bs. What else do they apply to? Qualified retirement accounts? Anything else?
Yeah, any of the other employer-sponsored plans, as well as inherited accounts, inherited Roth IRAs, as well as inherited pre-tax IRAs.
Okay, and required minimum distributions, I often think of them as the age that you are, because we talk about the age that you take them, but what's interesting on the inherited accounts is sometimes it's the age of the person that you inherited inherit them from. Is that right?
Yeah, just more rules we have to keep track of.
Look at me trying, attempting.
It's not a big deal. It's impressive that you're going there, yes.
Yeah, I'm trying.
Yeah, the required distribution, there's a calculation, and the calculation is either going to use your life expectancy, the 10-year time frame, or whomever you inherited it from, their life expectancy. So you really have to be careful about how you take the money out of these accounts, and that's why I say if you inherit an account, consult a professional, a CPA or a retirement planner. Just make sure you're following all the rules because you want to get the most out of that account as you possibly can. And I cannot stress enough for your accounts, make sure that you have a legacy plan in place so when you pass away, your accounts transition in the most efficient way and not a lot of those accounts are lost due to taxes and lack of planning.
Here's fact or fiction statement number 5. Moving to a no income tax state eliminates taxes.
That sounds really nice, but I think it is
Fiction.
Fiction, all right. I think you guys are right about that. And we know that one of the real popular Google searches are the best states to retire in. And these states are smart. They have marketing departments, they have economic development departments, and they make sure that one of the top things that come up is move to, again, the 8 states that have no income taxes: Alaska, Florida, Nevada, South Dakota, Tennessee, Texas, Washington, and Wyoming. Move there because you won't pay income taxes.
Right.
But there's a caveat.
Oh, what the states can control is the level of tax that they charge from an income tax standpoint. What they can't control is what is the level of the federal income tax. And so you can still be subject to federal income tax. You can still be subject to property tax. You can still be subject to an array of other taxes. But it is nice. It can be nice if you can eliminate the state tax. That's one element of taxable income that you can get rid of, but you still have to plan for and be aware of that there's a lot of other taxes that you could have to pay.
And if you're looking for the best state to retire in, you also have to look at Haley property taxes and a couple of other things as well.
Yeah, and there's even some states that don't even tax retirement income. So maybe they're not a no state income tax state, but like Iowa, they don't tax retirement income. So what that really means is that you're not going to pay any taxes on your traditional IRAs, your pensions, Social Security, and that can be tax favored or at least help keep people in the state versus moving to one of those tax-free income states like Florida.
And that has been a lot more common with states who are looking to help out retirees, because take a state like Iowa where somebody would retire and they're not bound to Iowa anymore, and we don't necessarily have the best weather in the world. I mean, there's a lot more attractive weather states.
Yep.
And then you throw the high tax rates onto it. So states like Iowa have really changed that. So now in the state of Iowa, if you're age 55 or older, your retirement income is not taxed. So your retirement income could be Social Security. It was already like that, but also income from your IRAs, your 401k plans, your pension income. That's a big one.
Roth conversions.
Roth conversions, that's huge, especially doing all the planning that we do for the families and individuals that we serve. So all of that income, age 55 or older, doesn't matter. You could be retired. You could still be working. That retirement income is not taxed.
Yeah, and I believe it's Illinois, Iowa, Mississippi, and Pennsylvania that don't have retirement taxes. Also, though, you have to look out for, I think, property taxes, I mentioned that. Sales tax, something worth investigating as well if you're thinking about moving, and estate taxes. And by the way, just so you know, pretty much no matter where you live in the United States, federal taxes don't go away.
Yeah, you cannot escape federal taxes. When you file your tax return, that's often what is being taxed on your income is you have to pay to the feds.
Unless you do some advanced planning like the family you were talking about,
Yep.
and you convert a lot of that money over, and the income that you have coming in is no longer federally or state income taxed, and that is one way you can at least minimize, in some cases, get rid of federal tax as well.
This is Retiring Today, and we thank you for watching.
Thanks for tuning in. If you enjoyed this video, click here for more fun and exciting content. And don't forget to subscribe to join a community of other like-minded individuals who are also exploring fun and creative retirement strategies.